A. Define business ethics. Business ethics refers to the principles, standards, and values that guide behavior in the business environment. It governs how organizations and individuals make decisions affecting stakeholders. Ethical conduct goes beyond legal compliance and emphasizes responsibility, transparency, and accountability. Business ethics influences corporate culture, governance practices, and internal controls. Ethical frameworks help managers evaluate dilemmas involving competing interests. Strong ethical standards promote long-term sustainability, stakeholder trust, and protection of organizational reputation and financial performance. B. Define fairness, integrity, due diligence, and fiduciary responsibility and their impact on ethical decision-making. Fairness requires objective, unbiased treatment of stakeholders. Decisions should avoid favoritism and discrimination. Integrity involves honesty, consistency, and adherence to moral principles. It builds trust within organizations. Due diligence refers to exercising reasonable care and competence before making decisions. Fiduciary responsibility obligates managers to act in the best interest of shareholders and stakeholders. These principles guide ethical decision-making by promoting accountability, transparency, and responsible stewardship of resources. C. Identify and explain different types of business fraud. Asset misappropriation involves theft or misuse of company resources, including cash, inventory, or equipment. Financial statement manipulation includes intentional misrepresentation of revenues, expenses, or assets to mislead stakeholders. Cash and inventory theft occur through skimming, larceny, or falsified records. Payroll fraud may involve ghost employees or falsified hours. Fake suppliers and accounts receivable fraud manipulate vendor or customer accounts for personal gain, damaging financial integrity and trust. A. Identify and describe the 4 overarching ethical principles and the 4 standards. The 4 overarching ethical principles are honesty, fairness, objectivity, and responsibility. These principles guide professional conduct and form the ethical foundation for management accountants. Honesty requires truthfulness and transparency in all professional relationships. Fairness emphasizes impartial treatment of stakeholders and avoidance of bias or conflicts of interest. Objectivity requires decisions based on evidence rather than personal influence. Responsibility reflects accountability and ethical stewardship. The 4 standards are competence, confidentiality, integrity, and credibility. These standards provide specific behavioral expectations supporting the overarching principles. B. Evaluate a given business situation for its ethical implications. Ethical evaluation begins by identifying relevant stakeholders and potential conflicts of interest. Understanding who is affected clarifies the ethical dimension. Candidates should compare the situation against IMA principles and standards to determine compliance. Assessment includes analyzing intent, transparency, and adherence to professional duties. Potential risks to credibility, legal compliance, or organizational reputation must be considered. Structured ethical decision-making process ensures conclusions are objective, consistent, and professionally defensible. C. Identify and describe relevant standards violated and explain applicability. Competence may be violated if professional duties are performed without adequate skill or care. Confidentiality is breached when sensitive information is improperly disclosed. Integrity violations occur when conflicts of interest are not disclosed or when actions discredit the profession. Credibility is compromised when information is biased, incomplete, or misleading. Proper identification requires linking specific behaviors to the relevant IMA standard and clearly explaining how the conduct fails to meet professional expectations. D. Recommend a course of action when confronted with an ethical dilemma. When facing an ethical dilemma, professionals should follow the IMA's established resolution framework. The first step is to discuss the issue with an immediate supervisor unless the supervisor is involved. If unresolved, the matter should be escalated to higher management, the audit committee, or the board of directors. Confidential consultation with an objective advisor or legal counsel may be appropriate. Professionals must document facts, communications, and actions taken. If internal resolution fails and unethical behavior persists, resignation may be necessary to maintain professional integrity and compliance with IMA standards. E. Evaluate and propose resolutions for ethical issues such as fraudulent reporting or improper manipulation. Fraudulent reporting or manipulation of forecasts violates integrity, credibility, and competence standards. Professionals must recognize intentional bias or misrepresentation as ethical breaches. Evaluation involves assessing stakeholder impact, regulatory implications, and reputational risk. The appropriate response includes refusing to participate in manipulation and clearly communicating concerns to management. Escalation through formal governance channels may be required. Proposed resolutions should emphasize transparency, correction of misstatements, strengthened internal controls, and reinforcement of ethical culture to prevent recurrence. F. Identify the three components of the fraud triangle. The fraud triangle consists of pressure, opportunity, and rationalization. These three elements must typically be present for fraud to occur. Pressure refers to financial or personal incentives that motivate an individual to commit fraud. Examples include debt, performance targets, or job insecurity. Opportunity arises when internal controls are weak or oversight is inadequate. Rationalization involves the individual's justification of unethical behavior. Understanding these components helps management accountants recognize conditions that increase fraud risk within an organization. G. Use the model to identify and manage fraud risk. Management professionals can reduce pressure by promoting realistic performance targets and supportive organizational culture. Opportunity can be minimized through strong internal controls, segregation of duties, and regular audits. Addressing rationalization requires fostering ethical leadership and reinforcing codes of conduct. Continuous monitoring and risk assessments help detect warning signs. By proactively managing each element of the fraud triangle, organizations can significantly reduce the likelihood and impact of fraudulent activity.